Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 May-June Paper 3-1 and Paper 3-3 question number 1. This is the structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for this paper is 1 hour and 30 minutes. Which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. B Limited carries on a manufacturing business making one product. It has a constant rate of factory profit. The following balances are extracted from the trial balance at 31st December 2023. So we have been given the machinery carrying value at the opening date, office equipment carrying value at the opening date, inventories at the opening date. We have been given the finished goods at transfer price. We have been given the sales, purchases of direct materials, direct labor, rent and rates, other indirect production overheads, other administrative costs, and we also have the provision for unrealized profit at 1st January 2023. Okay, further information is also available. We have been given the inventories at the closing date, again at the transfer price. Rent and rates are to be allocated 70% to the factory and 30% to the office. Accrued rent at 31st December 2023 was 15,000. This is the accrued rent at the closing date, which means that this should be added to the rent given above. So that will be 105,000 plus 15,000, which results in 120,000. And we need to divide it 70% to the factory, 30% to the office. So towards factory, that will be 120,000 times 70%, which results in the value of 84,000. And towards office, that will be 120,000 times 30%, which results in the value of 36,000. Okay, then the annual depreciation rate for machinery is 20% and for office equipment is 15%. The reducing balance method is used for both. Okay, so for machinery, we can start with our carrying value at the opening date, 258,000. 258,000 times 20%. This results in the depreciation of 51,600. Now for office equipment, again we can start with the carrying value, 98,000. So 98,000 times the rate is 15% in this case. This results in the value of 14,700. And we have not been given the rate of factory profit, but we do know that there is a constant rate of factory profit, and we have the opening finished goods at transfer price as well as the opening provision for unrealized profit. So we can easily calculate the rate from this two values. Okay, let's create an equation. We know that profit is just going to be transfer price divided by 1 plus rate times rate, and in this case we will be solving for rate. So the profit is just going to be our provision for unrealized profit of 25,600. The transfer price is the transfer price of the finished goods at the opening date, 89,600. Now let's solve for rate. Let's cross multiply this to the other side. That will be 25,600 plus 25,600 rate, and this will be equal to 89,600 rate. Let's bring this to the other side. So that is just going to be 25,600. 89,600 rate minus 25,600 rate, which will be equal to 64,000. So our rate of factory profit in this case is just going to be 25,600 divided by 64,000. This results in 0.4, which we can write down as 40%. So this is our rate of factory profit. Okay, let's start with the first part of this question. We need to identify the costs that may be included in the inventory cost of work in progress. Okay, for work in progress, these are the goods that is not raw material and not the finished product. So it's somewhere in between. And the cost that will be included will be the cost of direct materials. Let's write it down. So cost of the purchases of direct materials. The second cost to be included will be the delivery cost for these purchases. The third one will be the direct labor cost. And the last one will be the production overheads, or we can just split it up as fixed production overheads and variable production overheads. Let's just write down variable production overheads. Since this is a 4 marks, 4 of these costs will be enough. That is all for the first part. Let's move towards the second one. We need to prepare the manufacturing account for the year ended 31st December 2023. Okay, this is the manufacturing account. And this is for the year ended 31st December 2023. Okay, we will always start with the raw materials or the direct materials, and in this case we need to start with the opening direct materials right here, which is given as 16,000. Let's write it down. So we have the opening direct materials of 16,000. Then we need to add the purchases of direct materials. So the purchases of direct materials is 174,300. Let's take a look for any carriage inwards. In this case, we do not have any carriage inwards, so we can just include the closing direct materials inventory, which is 21,400. And that will be subtracted. So closing direct materials. That was 21,400. Now if we add it up, we will get the cost of direct materials consumed. That will be 16,000 plus 174,300 minus 21,400, which results in 168,900. Now we need to add any other direct cost so that we get the total for our prime cost. In this case, the only other direct cost we have is the direct labor of 158,000. Let's write it down. So 158,000 for direct labor. And then we can calculate the prime cost, which is just the total of our direct costs. So that will be 168,900 plus 158,000, which results in 326,900. Now to this we need to add all of our factory overheads. These are the indirect costs related to the factory. So the very first thing we can include is the rent and rates for factory, which we have already calculated to be 84,000. Let's write it down. So we have rent and rates to be 84,000, and we've also calculated the depreciation. In this case for machinery, that was 51,600. Let's write it down. So this is the depreciation on machinery, and we have the value of 51,600. Okay. Then we also have other indirect production overheads with the value 77,500. This is also part of our factory overheads because these are the indirect production overheads. Let's write it down. So we have other indirect production overheads with the value of 77,500. The next step is to calculate the total of the prime cost and the factory overheads. So that will be 326,900 plus 84,000 plus 51,600 plus 77,500, which results in 540,000. The next thing is to adjust our work in progress. So we add the opening work in progress inventory and we subtract the closing work in progress. Let's take a look above. For the opening work in progress, we have the value of 47,000, and for the closing work in progress, we have the value of 52,000. So the opening was 47,000, we add it, and the closing is 52,000, which we subtract. Now we get our cost of production. That will be 540,000 plus 47,000 minus 52,000, which results in 535,000. Now we just need to add the factory profit and get the transfer price. For the factory profit, we need the rate of factory profit, which we have calculated above, to be 40%. So in this case, our factory profit is just going to be 40% of the cost of production. So 40% times 535,000, which results in the value of 214,000. So the transfer price will be 535,000 plus 214,000, which results in 749,000. That is all for our manufacturing account. Let's move towards the next part. Now we need to prepare the statement of profit or loss for the year ended 31st December 2023. Okay, so this is the statement of profit or loss, and this is for the year ended 31st December 2023. We will always start with sales for the statement of profit or loss, and the sales value was given above. Right here, it's 933,000. The next thing we do is subtract our cost of sales. So the cost of sales will include the opening finished goods inventory, and this will be included at the transfer price. Then instead of purchases, we just add the transfer price that we calculated within the manufacturing account, and we subtract our closing finished goods inventory. This will also be included at the transfer price. Let's take a look above for these values. So for our opening finished goods inventory, it's right here and has a value of 89,600. For the closing finished goods at the transfer price, we have the value of 77,000, and for the transfer price from the manufacturing account, we got the value of 749,000. Let's write it down. So opening finished goods had the value of 89,600, transfer price had the value of 749,000, and the closing finished goods had the value of 77,000. Let's get the total. That will be 89,600 plus 749,000 minus 77,000, which results in 761,600. Now we can get the gross profit. That will be 933,000 minus 761,600, which results in 171,400. Now we need to add the factory profit to the gross profit, and we need to make the adjustment for unrealized profit. Okay, so factory profit in this case was just 214,000. Let's add it. And for the adjustment for unrealized profit, we just need to calculate the provision for unrealized profit at the closing date and compare it to the opening value. If there is an increase, we will subtract it. If there is a decrease, we will add it. In this case, we have the finished goods at transfer price at the closing date of 77,000, and we will use this formula. So our profit will be 77,000 divided by 1 plus rate, which we calculated to be 40%, times rate. This results in the value of 22,000. So this is our closing provision for unrealized profit. Now we compare it to the opening value, which was 25,600. Clearly there has been a decrease, and the decrease is of 25,600 minus 22,000, which is 3,600. Since this is a decrease in provision for unrealized profit, we will add it as part of our adjustment. Let's write it down. So that will be 3,600. After we add it up, we will get our effective gross profit. So that is 171,400 plus 214,000 plus 3,600, which results in the value of 389,000. After this, we can subtract the expenses. Let's take a look above. We first have the depreciation on office equipment of 14,700. Let's write it down. So we can just write down expenses as our heading, and the first one will be depreciation on office equipment, and the value is of 14,700. Then we also have rent and rates to the office of 36,000. Let's write it down. So 36,000 as rent and rates. And I think we have been given other administration costs as well, right here, other administrative costs with the value of 205,000. That should be all for the expenses. So we have 205,000 as other administrative costs. Let's get the total for our expenses. That will be 14,700 plus 36,000 plus 205,000, which results in 255,700. This we need to subtract. Then we get our profit for the year. That will be our effective gross profit of 389,000 minus the total expenses of 255,700, which results in the value of 133,300. That is all for our statement of profit or loss. Let's move towards the next part. We have been given some additional information. The product of B Limited is well received by the market. The directors plan to incur 100,000 expenditure on researching a new material that will extend the life of the product. We now need to advise the directors whether or not they should incur expenditure on researching a new material. We need to justify our answer. Okay. This is a 5 mark, so 1 mark will be reserved for the decision and 2 for this plan and 2 against this plan. Okay, let's write down for the plan. If we research more on a new material, then it just means that it will be of better quality. Let's write it down. New material may be of better quality. Then the second comment can be, if we research on new material, we can also make it to have less wastage. So we can see that this will reduce cost of wastage. Now against, if we go with this research, we do not have any guarantee that the research will succeed. So the research may fail. That is the first point. And another thing is that we can comment on the expenses. We need to incur a total of 100,000, and this might need to be financed by some sort of loan. And if we take out a loan, it means that the loan interest will again reduce our profit. Let's write it down. May need to be financed by loan. And the loan interest will reduce profit. Okay, now based on these factors, we need to make a final decision. So personally, I would advise the directors that they should incur this expenditure on researching a new material because it will ensure profitability in the long run. Let's write it down. The directors should incur expenditure on researching a new material as it ensures profitability in the long run. That is all for the fourth part as well as this entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.